And we're live. It's Chris Matlinowski and Quinn Berry with the Built in Calgary Group. And today we've got Joe Jacobs here with Mortgage Connections. And we're talking a little bit about mortgage rates, what's happening with them right now, what we can sort of expect to happen, and more emphasis on why actually purchasing right now may be more advantageous to you than sticking in the rental pool. So, Joe, as always, good to have you share some of your thoughts with us today.
Oh, thank you. My pleasure. Thanks for having me. Appreciate it.
Yeah. Joel, what are you sort of seeing here in this last quarter with mortgage rates? I know that the US bumped up their rates. Was that a reflection as to what happened here in the last little bit with the rate hike in or the rate drop in Canada?
So the US and Canada are definitely going to move fairly similar uh, time frames. If one's moving, they're likely moving in the same direction. They don't necessarily tie together precisely though. So we've certainly seen the Bank of Canada aggressively been increasing rates in the last 6 months. It's totally just them trying to get a hold of inflation. The reality is the Bank of Canada doesn't actually have to move rates as much as the US to have the same results. Just a matter of there is more consumer debt, frankly, in Canada. So a increase in an interest rate here from the Bank of Canada has more impact than it does in the States. So the States very likely will move further than Canada will, but we are probably not done the rate hikes yet. The Bank of Canada meets again on the 7th. The market is kind of pricing in 0.25 to zero point 0.5. Hopefully we're at that 0.25 range because inflation has come down a little bit. It's coming in where the market's anticipating it. So hopefully we're near the end of these rate hikes, and then it's probably going to be quite a long period of the Bank of Canada just sitting and waiting and watching and seeing how all these hikes are actually impacting things because there's always a delay in seeing how the market's actually going to truly react to it.
Mm-hmm. So you were talking about consumer debt. Like, what is the consumer debt currently at right now, and what would the Bank of Canada, or what would Canada like to see the consumer debt level sit at?
Well, it's as high as it's ever been. So kind of the factor that they use is debt to income ratio, and right now in Canada that's basically 180. So for every dollar that someone earns, they have $1.80 in debt. That's high.
Yeah.
It's as high as it's ever been. It's maybe not the only thing to think about, but it's definitely a concern for Canada. They don't necessarily have an exact target on it, but they just are concerned that it's there. Their biggest target is just inflation. They want to get inflation down to that 2% zone. They're a ways away from that. The latest numbers came in at 6.9. So those rate hikes are just fully focused on inflation. It's just that what I'm trying to get at is that because there's more debt in Canada, more people have a line of credit or more people have consumer debt, any increase in interest rates will impact the Canadian market a little more than our neighbors to the south.
Yeah. With Calgary, it's such an interesting market. When the rest of Canada seem to zig, we're zagging, and that's a combination of things. Whether that be product supply, or the lending change, or the lending rule changes that have happened over the last 6 or 7 years here. Right now, Calgary is in a really unique position because what would appear on the surface of a slowdown is interest rate hikes, when in fact a lot of what's happening is our supply, the inventory levels that we're seeing right now. I mean, under 500,000 for townhomes, single families, even apartments, to some extent. We've got buyers, they're sitting on the fence, but we just can't seem to produce enough inventory right now. With that being said, our last conversation, we were talking about increase in rents that are happening right now. And you had made mention as well that as renewables come up with current landlords, I mean, they're in a position where they've got to increase their rents to offset their current payments. So, we're seeing rents go up. Landlords, have to do it, in order to, make their rental income viable. Why right now, should we try to be, letting renters know that this is the best time, or is waiting till next year a better time to probably get into the ownership market versus owning a rental?
Yeah, so I mean, I think you're hitting a lot of the kind of key factors that people have to look at. I mean, interest rate cost is just one of the factors. So obviously, interest rate costs are going up. So as a buyer, your mortgage expense is going to be higher. But I think you're bang on with the supply issue. Alberta is in a situation where there's massive net migration here. There's massive just immigration happening in Canada too. And Alberta's being seen as a bit of a shining beacon in a country where the rest is not doing nearly as well. So I don't foresee a slowdown in Alberta. We haven't seen the crazy price increases that you've seen in, the GTA or Ontario or in the Vancouver regions, but we are in a place where we're seeing increases in prices happening, and a lot of factors that you're talking about. When there's just not supply, that's going to lead to demand. There's people moving in, that's going to lead to demand. And so there's probably a better chance that you see at least slight property growth from a value standpoint in Alberta. And so, your cost to buy is going to go up. Now, what are interest rates going to do? No one knows, but I don't think we're in a market that you're going to see significant drops in interest rates in the next 12 months. Hopefully, we see the Bank of Canada pull back on increasing rates. They've increased them, a massive amount in the last 6 months. So I think at best, you're probably going to see a fairly steady interest rate market for the next 12 months. But that could be coupled with increased real estate costs. So if you look at, is it better to buy today or down the road? If interest rates stay stable at all, you're definitely better to buy now. If interest rates even go up a little bit, you're way better. If they come down a little bit, and real estate goes up, over 5%, you're still going to be better to do it today. So, if you're renting, all that money's going to a landlord, all that money's going to essentially interest because you're not paying down anything. So I think there's always a case to be made in a rising rental market that, buying now may be the way to go.
Yeah, I think if I'm sure yourself or Amy is available to, have that discussion and sort of, make up a spreadsheet. If your rent is sitting at whether that be, 1,700, 2,600 bucks a month, if you were to, look at a similar priced home, and what that would cost in today's market, down payment aside, and if your credit is not the best, I mean, it certainly would seem that, you know 20, somewhere in the neighborhood of, if you were to say on average payments of $2,000 a month, $24,000 a year, could you be applying that to a mortgage, and your mortgage pay down on something like that is probably somewhere in the neighborhood of $7,000 to $8,000 a year. You've got a net realization, and I think you are correct. I think we are going to see a slight increase on home prices still, as long as our inventory levels under 500 and the demand being there. That can only put more upward pressure, on that market, and a slight increase on the next market range of homes, so to speak, right? So yeah, I'm sure you and Amy, as I said, would be open to those conversations there. Coming into the new year, you had alluded to the fact of, you're not sure if they'll do another interest rate hike in the new year or not, and I guess as long as inflation is still looming, that's probably the indicator that they will do another interest rate hike. And if it's coming down, maybe not. If that is that correct, and what your thoughts?
Yeah, I mean, inflation's all they care about right now. So,
Mhm.
you're definitely gonna see another hike in December. I normally don't say definite, but the market's telling us that's happening. It's just a matter of it's a quarter or a half. Beyond that, it's really tough to say. They're going to be kind of where a lot of the economists think they need to end up after the next hike. So their messaging has changed a little bit in the last couple increases, where it sounds as though they're going to be a little more cautious in continuing to increase rates and waiting to see how the market reacts. So if I was to guess, and of course this is a guess, I think you'll see an increase of a quarter point in December. I think you will then see the Bank of Canada take a breath, at least for the first meeting, and see how things go. I mean, obviously there could be factors that totally change this in the economic forecast, depending on what happens in the world. But that would be my guess in the near future. But again, I don't think that means rates are coming down. The Bank of Canada will likely hold rates at a higher level than they even maybe have to, just to make sure inflation doesn't rear its ugly head again on them. So you're probably in a rate market that's fairly consistent to what you're at today in the next 12 months. They will give it a long period of time, even if inflation numbers are coming in where they want, to make sure that they don't have a situation where inflation jumps back up. So they may keep rates higher than they should for a longer period of time, just because they don't want to have a situation where they move it down too quickly.
Yeah, so if I'm hearing you correctly, you're saying for the holiday season, instead of giving more, less is more with the Bank of Canada in terms of the gift to the rest of Canadians.
Yeah, I think so. I think so. Yeah.
Yeah.
Yeah, that's for sure.
So if people are looking at getting into the market here, I mean, obviously there's a lot of different rate programs out there right now. Is there one program that may be a little bit more favorable or than, jumping into your traditional 5-year fixed?
Yeah, so there's a couple of things we can look at. The one concern on interest rates is that they are maybe at or near the top of a rate cycle. So if you go into a 5-year fixed rate now, you might be, paying more than you have to over the long run. So what we're seeing a lot of clients do is one of two things. If they are of the belief that the Bank of Canada is going to eventually bring rates back down somewhat, and they're okay with a little bit of movement, they will look at a variable rate still. There's still great discounts off of prime available on a variable. For those that are really concerned on payment and rate and potential movement, we're seeing a lot more shorter term fixed rates being the way to go. So a lot of people are looking at 2 and 3 year fixed rates. The idea behind that is let's ride out this rate cycle. If the Bank of Canada holds rates high for another year, we might see rates start coming down in 2024. And so you're going to have that ability to then capture a falling rate market is the idea. If not, you still have security for the next couple of years, but you're not going to be in a situation where you have a higher interest rate, you want to get out of it, and you have really high penalties to do that if rates drop. So the risk you take on a 5-year fixed is if you want to break that mortgage for whatever reason, like rates drop 0.5%, you just won't be able to. It'll be too expensive to get out of it. So we're definitely seeing way more 2 and 3 year fixed rates than we normally see in the market, but it's definitely an option that makes sense.
Yeah, yeah. No, that's really good advice. Awesome. Well, I appreciate you sharing your thoughts here and your crystal ball prediction, so to speak.
Yeah, it's not a crystal ball, but you bet.
Yeah. If somebody's looking for more information or looking to get a mortgage, how can they reach out to you?
Yeah, so you had mentioned myself and my partner Amy, who I've worked with for 20 years. Either one of us would be happy to help anyone. So best is probably just email. So it's just joe@mortgageconnection.ca. And that's probably the best way to reach me. What I will do though, because I know you've got a group of potential clients, is your point on the spreadsheet is one that's a good one. So what I can send, and then if you want to send it out to anyone, is just a breakdown on what it would look like today versus potential price increases and rates kind of doing what we think they're going to do. Because once you get over that kind of 5% increase in price, it starts becoming really apparent that you're better off doing something today, not even taking into effect what it costs you to just rent a property. So
Yeah, yeah. No, I really appreciate that. Cool. Well, hope to chat with you again in the first quarter here, and yeah, do another mortgage update with you. Appreciate your time on this.
okay, my pleasure. I hope you all have a great holiday season, and we'll talk to you soon.
Okay,
Thanks,
cheers.
Joe.
Bye.